Hello, this is Dan Passarelli with Market Taker Mentoring here on the floor of the CME Group. Well, it's a somewhat quiet day. We've had a little bit of activity to the upside, which we haven't seen in a few sessions. And today, I'm looking for credit spreads. Why credit spreads with the VIX at these very, very low levels? Well, because you know why? Historical volatility is significantly below implied volatility in a lot of stocks. Even though the implied volatilities are at 6 months low in many stocks, it's still too high. Now, one stock that I love trading credit spreads on, and I put one on this morning, is Johnson & Johnson, symbol JNJ. The trade I put on is selling the February 72.5 calls and at the same time buying the February 75 calls. Now there's some resistance up top below that level in Johnson & Johnson, so I like that. That means the stock has been having a hard time rising beyond the resistance level. We've got plenty of room up to 72.5 above and beyond that resistance level. This is a high probability trade. The options are overpriced in terms of implied volatility. Now this morning I was able to sell that spread for 50 cents. That means as long as Johnson & Johnson does not rise above 72.5, I get to keep that full 52 cents. In fact, the stock can rise all the way up to $73 a share. Now that's a high that we haven't seen in a very, very long time. If Johnson & Johnson does end up rising above that level, which the odds are against, but if it does, I can always do some sort of adjustment and possibly still take this trade and keep it a winner. If Johnson & Johnson stays where it is, just rises a little bit, or even falls, then the trade's working out great. I probably won't hold this trade all the way until expiration. Once I can buy the spread back, or at least the 72.5 calls back for a nickel or less, I'll close the trade and take the profits. This is Dan Passarelli here on the floor of the CME Group with Market Taker Mentoring. You can learn more about Market Taker at markettaker.com.